This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks climb, led by Japanese shares, with the BOJ now widely expected to end its negative interest rate policy tomorrow. China's factory output and investment grow more than expected, showing stimulus measures are helping. However, consumers are still not stepping up. Plus, Israel's military targets Al-Shifa hospital in Gaza, citing Hamas activity, as Prime Minister Benjamin Netanyahu vows to continue the war. It's just gone 8 a.m. across the Emirates. I'm Lizzie Burden in Dubai. Happy Monday. Welcome to a new week. And it's set out to be a major week for central banks. We have got the Bank of Japan's decision tomorrow. A solid minority of economists expecting it to end its negative interest policy, to hike rates for the first time in 17 years. Markets fully pricing a hike tomorrow now. Epoch-making is how Nomura describes the significance of policy normalisation, both for the Japanese stock market and for the economy. On Wednesday, we get the Fed's decision, an updated dot plot to come with that. And on Thursday, the Bank of England could deliver an even more dovish vote split than we got last time. So, as we await all that, you are looking at the MSCI Asia Pacific Index boosted by Japanese equities because of the weaker yen and these expectations that the currency isn't going to strengthen even if the BOJ hikes. You've got European futures flat to the upside there and US futures pointing to a higher opening as well after a dismal end to last week on Wall Street. If we flip over to the cross-asset picture now, you've got the two-year Treasury yield steady at 4.72%, but this is a real climb from where we were last month because traders have pared back those Fed rate cut bets. The dollar is pretty steady there after its best week since January. Brent steady as well at $85 a barrel after its biggest weekly advance in a month. This is as those Ukrainian drone attacks on Russian refineries stoked geopolitical risks. And you've got iron ore trading at $101 a tonne, has been at its lowest level since last May. But we can get more perhaps on why by crossing over to Avril Hong. She's waiting for us in our Singapore studio and she's had an eye on the Chinese data out this morning. Avril, tell us more.
Yeah, Lizzie, it was a bit of a mixed bag. If you take a look at the retail sales numbers, they were a slight disappointment. But industrial production, the pickup was better than expected. So investors seem to be reading this as a sign of the stabilization in the Chinese economy. We saw the CSI 300 climbing about 0.5% in the morning session. The offshore yuan moving closer towards the 720 level. Yields not really giving us that much direction. Neither is the Hong Kong benchmark. Let's flip the board and take you to what we're seeing in Japan cross assets as well, because it's not just about China data that we're keeping an eye on this week. It's really about the BOJ and the Fed and how they are going to set the near-term direction for global markets. And we have swaps markets really pointing to a move from the BOJ tomorrow and reports that suggest we're going to see that rate lift off to 0 to 0.1%. But of course, it's not just about that. It is also whether we get any forward guidance from the BOJ, especially given how big the yield gap is between the US and Japan. And the yields are reversing some of the moves on the 10-year that we saw last week. The yen still relatively weak. That's helping what we're seeing in the equity space, although the gains on the topics capped slightly by the declines in the mining and energy-related counters, Lizzie.
All right, Avril Hong, thanks for that update. And I want to continue the conversation about this week of decisions for central banks. We've got the Fed and the Bank of Japan, as Avril says, among those set to make rate calls that are going to affect half the world's economy. Economists see the Fed holding steady, while Japanese media reports say that the BOJ is finally going to end its negative interest rate policy when it makes its decision tomorrow. So let's bring in more on the markets. Executive Editor for Asia Markets, Paul Dobson. Morning, Paul. The BOJ then, what sort of market reaction are you braced for when traders have fully priced in a hike for tomorrow?
Good morning, Lizzie. So maybe that's it. And I think it would be the BOJ's dream scenario if there were no market reaction when they finally go ahead and raise interest rates. out of the negative territory either this month, or at least giving a very strong signal for it this month, because they would have felt that they well prepared the market for such an eventuality. That certainly seems to be the way that we're headed at the moment. There's relative calm in the yen in particular, but also in the rates markets, and equities, still seem to feel that there's some positives for them out there as well. So it may be that we're so ready for it to happen now, and all of those pieces of the jigsaw have come into place, that they will be able to do it with a minimum impact on markets, with causing as little harm as possible, at least for the short term. The longer term implications will be something that we'll be gaming out for weeks and months ahead, I'm sure.
OK, Governor Oweda keeps his fingers crossed. What about a surprise then from Jay Powell? Do you think that he will sound dovish this week, given his history of being sensitive to signs of slowing activity, even though we've had those hotter than expected inflation prints?
It's getting harder and harder for him to do that, isn't it? There was a quote that was in one of our stories over the weekend saying, the Fed wants to lower interest rates, it wants to start cutting, but the data just don't want to support such an argument. It's been so strong coming through, maybe you could say uneven, but definitely to the strong side, particularly for the inflation. So it's harder and harder for Powell to signal that rate cuts are imminent. And the policy is, really doing enough to bring down inflation at this point. So I don't think that he will change his tone dramatically. He'll continue to sort of apply that same line. But we know, and the market knows, based on the pricing, that any cut in interest rates is unlikely to come before the second half of the year now.
And just finally, Paul, on the Bank of England, we get CPI the day before the BOE decision. Is this month's meeting finally the meeting when we have Catherine Mann walking back from her hawkish stance?
I think that's a possibility for sure. What I think is really interesting here when we're talking about the Fed, we're talking about the BOE, is that who goes first dynamic. Who's going to go first? Who's going to go hardest? Is the BOE going to jump ahead of the Fed in terms of the queue for lowering interest rates? Is it the ECB that's going to lead the way? Certainly what we've heard from the European policy officials has been talking up the prospects of an earlier cut, of more aggressive cuts all the way through the year. I think we had Ollie Rehn over the weekend talking about a series of cuts, for example. So if that sequencing switches around in investors' minds and we then have ECB, BOE both coming before the Fed, there could be some interesting currency market implications, watching for what it means for the relative value in the long end of interest rate curves, but also in the currencies of pound, euro and the dollar, of course.
All right, Paul Dobson from our MLive team, thanks for taking us round those central banks. And of course, we've been asking many of our guests about what the BOJ is going to do, their views regarding the Nikkei and the rate hike and how it's going to mark the end of the bull market in Japanese stocks. Take a listen.
We've been saying that the Bank of Japan is very likely to be tightening policies.
My view is that it will be a very dovish exit.
Market split between a March and April exit from negative rates.
Japan raises interest rate, the US goes lower, the yen strengthens a little bit.
I don't think that they want to risk any financial instability.
The stock market has performed very well on the weaker yen, amongst others. So that could take a bit of the zest out of that.
Yes, there will be hiccups, and it seems that these couple of months would be a little bit rough for Japanese equities, but at the same time, they can give you opportunities.
The money then leaves Japan. Where does it go? That's the interesting one. And that could bring us back maybe to China.
Well, let's continue this conversation and bring in Rajiv DeMello, Global Macro Portfolio Manager at GAMA Asset Management. Good morning, Rajiv. Great to have you on the programme. The BOJ, is it going to just scrap negative rates, or is it going to do yield curve control as well?
Well, I think they'll do. They'll remove their cap on rates, which is bond yields, which is called yield curve control. They have a good chance of moving up to zero from their negative interest rates. I think that's something they've been signaling to us for the past week or so. And the wage data which came out, or the wage negotiation data which came out last week, shows that wages in Japan are going up, which is one of their remaining criteria to exit this incredibly unorthodox and stimulative policy they've had for so many years. So it is really a momentous meeting tomorrow.
OK, momentous. And then we also look to the Fed's decision, of course. Larry Summers told us that there was a meaningful chance the Fed's next move could be a hike. What do you make of that?
Yeah, I mean, I'm a great fan of Larry Summers. He really explains things very well. But I have to disagree with him on this rate hike expectation that he's expecting. I do think that the Fed's moving to a cut the next time, most likely in June. We are seeing inflation coming down, even though it's slower than expected. It is declining, and so real interest rates, the difference between interest rates and inflation, is going up at a time when the economy is moderating its strong pace of the end of last year. So the Fed has pretty much signaled through its dot plot, which is its expectations, its own expectations of its rates, that they're going to cut 3 times. And Chair Powell reinforced that message in recent speeches. So I think he'll stick to that and indicate to us that he's going to cut rates 3 times this year. So that's pretty much on the Fed's plan. So no rate hikes.
All right. What about the recession risks? Jamie Dimon says you can't rule out a US recession. Is he right?
Recession risks are there, and I think it's important to keep them in mind. After all, we've had this tremendous tightening in monetary policy, which over the last 3 years, and that's unprecedented really since the 1980s. So it will have an effect somewhere. It's taking longer to materialize. The economy is holding up well, but there are signs of pressure, and I would keep that recession risk in my scenarios.
OK, we've talked about how nobody wants to cut first. When the ECB does start cutting, June being the date that Christine Lagarde has telegraphed, is it going to cut faster than the Fed?
Yes, I think that the ECB has to cut faster than the Fed because the European economy is weaker. It has not got that exceptional boost that we're seeing in the US. And so the ECB has been waiting to see some of the wages in Europe calm down. And that's what's kept it from cutting earlier. Now it'll have to do some catch up and cut rates. And I think they will cut at a faster pace than the Fed, just because of the weakness in the European economy relative to the moderate or strong growth in the US.
And you've seen very low volatility, Rajiv, in equities and some currencies. Are markets too complacent about the potential macro risks from central banks, as well as the geopolitical risks and the risks from the elections around the world?
Yes, that implied volatility, which is the volatility one derives from the options market, does indicate very little risk going forward. And that does concern me because once the market gets too complacent and all investors are pretty much in the same view that everything will be fine, that the central banks will manage this reversal of policy in the case of the BOJ, an exit to the upside in the case of the others, to the downside with these recession risks, that's the time when there is more risk to the markets because there's less insurance bought out and people can be surprised. So this low volatility does worry me. The problem with low volatility as a signal is that it can stay low for a little while, and it has been at low levels since the beginning of the year and declining. So when exactly the trigger will happen, that is something which is difficult for investors to really plan out. But indeed, that is a concern, this very low level of volatility in all financial markets.
OK, Rajiv De Mello, Global Macro Portfolio Manager at Gamma Asset Management. Brilliant to have you on the programme this morning. Thank you. And speaking of nobody wanting to go first to cut rates, it's interesting, ironic, isn't it, that if we look at central banker pay, as you can see on the screen there, Jay Powell, the man who is set to start the pivot party, is actually one of the lowest paid of the major central bankers. You can see him there trailing the Bank of England's Andrew Bailey, the ECB's Christine Lagarde, the BOJ's Governor Ueda. In fact, the best paid central banker is the SNB's Thomas Jordan. He's on the equivalent of just over $1.5 million. And then it's Eddie Yu, who leads the Hong Kong Monetary Authority. He's on the equivalent of $1.32 million a year. We reported that the Hong Kong government's considering keeping Eddie Yu as de facto chief after his term expires in October. The government, of course, wants to avoid market disruption at this fragile time for the financial market. But poor old Jay Powell there on $203,000, not to be sniffed at, but chicken feed, really, in the scheme of central banking. Well, that's that on central banker pay. But still ahead, we're going to be keeping an eye on oil moves as economic activity in China beats expectations and Ukrainian attacks on Russian refineries heighten geopolitical risks. Nomura Asset Management shares their outlook later in the hour. But first, Benjamin Netanyahu has rejected calls for fresh elections and says Israeli troops will enter the southern Gaza city of Rafah within weeks. We'll bring you the latest on the war there. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, Israel's military has made its deepest incursion into Gaza City in about 2 weeks, targeting Al-Shifa Hospital and citing Hamas activity. It comes as Prime Minister Benjamin Netanyahu vows to continue the war. He also pushed back against comments by US Senate Majority Leader Chuck Schumer, who last week called for Israel to have new elections.
What he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic.
So, Stuart, despite the international pressure to end the war, Stuart Livingston-Wallace, I forgot to introduce you. You're in the studio with me. Despite this pressure, Israel's War Cabinet on Friday approved the assault on Rafah. How is this going to play out? What sort of time frame are we talking about?
I mean, in effect, it's a negotiating tactic, I suppose you would say, because simultaneously they're sending people to Doha to continue the ceasefire talks. So it's a way of increasing pressure to some extent on Hamas. But the reality is they've been saying this pretty much since day one. I don't think there's been a change of strategy there. And fundamentally, it comes down to the stated aim of this, which is to eliminate the Hamas leadership. You cannot do that unless you go into Rafah. There's no other way. OK,
but then where are the Palestinian civilians there going to go if they've been sheltering there?
Yeah, that's an extremely good question, and no one has had a good answer to this. So the normal playbook that we've seen over the last 4 or 5 months is that Israel typically puts out some sort of public notice telling civilians you're going to move on this road at this time during these hours, and you know your safety will be guaranteed. Now, of course, the reality is that's not what happens on the ground.
And what I'm asking myself is, surely Hamas is going to go where they go?
Yeah, that's exactly what's been happening. So it's something like 300 to 500,000 people still in northern Gaza, about maybe 1 to 1.2 million people in Rafah. Assuming that they go north because there kind of is nowhere else to go. That means you're going to end up with something in the order of 1.5 million people in northern Gaza. We've all seen the satellite images. We know what it looks like. We also know that aid is trickling in, and despite these US efforts, first to airdrop aid in and now to build this sort of floating dock, it's clearly not going to be enough, and it's not going to be there in time to do anything much for that number of people.
Yeah, and you heard the pugnacious tone there of Benjamin Netanyahu in that interview. He's totally ignoring the US at this point. Is it at all likely that the US is going to change its stance on Israel in practical terms?
It's very hard to see what leverage Biden now has. I think the difficulty that he's facing, he's got an election coming up in November. We know that Michigan is a swing state. We know that this is a really big issue there. So it may be a little bit of a stretch to say this, but you can certainly theorize around the idea that to some extent, this puts his re-election at risk. That's for sure.
OK. Interesting to see how it plays out domestically for Biden. But just going back to what's happening on the ground, there's also the news that Israel's defence forces are conducting operations, as I mentioned, in the area of the Shifa hospital. This is according to an IDF Telegram post. What do we know?
I mean, to some extent, it's quite alarming because it had been, I mean, I wouldn't say quiet, but things had calmed down somewhat in that area. And we thought those operations were more or less completed. I mean, that was certainly what was being telegraphed by Israel. The fact that they're going in again suggests that they're not really solving the problem. Or at least from the IDF's point of view, there is still a threat there. And they're talking about, you know, they've picked up signs that terrorists are operating there again and so on and so forth, which is genuinely quite surprising in terms of everything that we've been told over the last couple of months since those operations have more or less ended.
OK, Bloomberg's Stuart Livingston-Wallace with the latest on the Israel-Hamas war. Thank you for that. Plenty more still ahead. This is Bloomberg Daybreak Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, we were just talking about the geopolitical situation here in the Middle East. Let's now talk about the trade impact. The CEO of Hapag-Lloyd, Rolf Haben Jansen, says that the Red Sea shipping diversions may last a few more months. He's been speaking with Bloomberg TV and says that he still sees services stabilising and spot container rates going down.
If you compare the situation now with what we had at COVID, there, of course, rates exploded. Today, you have a different situation because there was probably some spare capacity in the industry when this crisis hit us. And that has certainly helped us to keep global supply chains going and also to keep the increase in cost within reason.
So if there isn't any pushback, why are some of the profitabilities coming down? Just simply because if you can pass it along, are people shipping less? Are they looking to different routes that are shorter?
I think right now you are still looking at the results that come out on companies in the fourth quarter, where we had exceptionally low rates that were way below cost. That's also why a lot of companies posted losses. I think you will see a recovery in freight rates when you start looking at the first and second quarter. The question is, of course, what's going to happen once the situation around the Red Sea normalizes.
I want to talk about the situation in the Red Sea. The United States seems to be in a cycle of defense, not deterrence when it comes to their posture. Are you seeing any signs of deterrence from the United States or the UK or others when it comes to the Houthis?
Well, first of all, let me say that we really welcome all the efforts that are being undertaken by the US and their allies to try and stabilize that situation. But of course, it's very difficult because it's a fairly large area that you need to defend. And so far, we have seen that the attacks of the Houthis continue. And that also means that we will then decide we have no other choice than to keep our people safe, even if that means that, some of the supply chains are then 7 or 10 days longer.
Well, what are governments telling you about securing the Red Sea? Do you have a timeline of when you think you could start using that route again?
I think there are many different opinions on when that is going to happen. I think we hope that we're going to be able to go back through in a couple of months. But I know there are also people that think that it may last quite a lot longer.
Plenty more still ahead. This is Bloomberg Middle East and Africa. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks climb led by Japanese shares, with the BOJ now widely expected to end its negative interest rate policy tomorrow. China's factory output and investment grow more than expected, showing stimulus measures are helping. However, consumers are still not stepping up. Plus, Israel's military targets Al-Shifa hospital in Gaza, citing Hamas activity as Prime Minister Benjamin Netanyahu vows to continue the war. Well, it's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai. Good morning. Welcome to a new week. And it's a big one, it's set up to be, for central banks. You've got the Bank of Japan decision tomorrow. Markets fully pricing a hike for the first time in 17 years. You've also got the Fed decision, a dot plot coming Could we see some changes there and we get the Bank of England's decision? Could we see an even more dovish vote split this time? So as we await all that, you're looking at the MSCI Asia Pacific boosted by Japanese equities because of the weaker yen and the expectations that the currency won't strengthen even if the BOJ hikes. European futures flat to the upside there as we await the Eurozone CPI data at 2 p.m. Dubai time, and US futures pointing to a higher opening after a dismal end to last week on Wall Street. If we flip over to the cross-asset picture now, you've got two-year Treasury yields pretty steady at 4.72%, but this is notably a real climb from last month as traders have paired their Fed rate cut bets. The dollar steady there after its best week since January. Brent steady as well at $85 a barrel after its biggest weekly advance in a month. This after those Ukrainian attacks on Russian refineries stoking geopolitical risks. And you've got iron ore trading at $101 a tonne at its lowest level really since last May. And we can talk more perhaps about why when we get to Avril Hong. She's on standby for us in our Singapore studio, and she's been mining that China data as well as what else has been happening in Asian markets. Avril, over to you.
Yeah, Lizzie, let's recap what we got out of China data this morning. For the first 2 months of the year, it showed us how retail sales, there was a slight disappointment there. The property side of things still a major concern, but I think what investors focused on was the pickup in factory output that was better than expected, along with fixed asset investment. We are at a stage, it seems, where markets react more to positive surprises than negative ones. So the CSI 300 today climbing about 0.5% in the morning session. We'll check in about half an hour how it starts the afternoon session. But I guess let's flip the board and take a look in the meantime and take a closer look at iron ore contracts in Singapore. It seems to be similarly that argument that what positive surprises come through for the market matter more at this stage. Iron ore contracts in Singapore, as you flagged earlier, Lizzie, are recovering today, but note how it ended last week below the $100 a tonne level, and it lost almost double digits on that futures. That contract is really about China's demand. That is the drag for the commodity, and that is what we're seeing when we take a look at the commodity today. Lizzie.
Avril Hong in Singapore, we thank you for that update on Asia markets. And now let's bring it back to the Middle East, because Saudi Arabia's sovereign wealth fund is said to be in talks to acquire the kingdom's flagship airline, Saudia. Sources say the deal could result in the company being taken private or merged. For more details, we're joined now by our Saudi Bureau Chief, Christine Burke, from Riyadh. Christine, what do we know about this possible deal?
Well, good morning, Lizzie. So the first thing that I will say about these discussions around the Public Investment Fund possibly taking ownership of Saudia is that we understand these discussions are at an early stage. So sources have told Bloomberg that if a deal does indeed go ahead, we're not likely to see any action on this actually taking place until 2025. But the idea is that the Public Investment Fund will take ownership of Saudia from the central government with the aim of turning the company into one that is more profitable and more efficient. If the PIF is able to do that, then that may pave the way for a possible privatization of the company, or perhaps even a merger, specifically with Riyadh Air. Just a bit of history for you here. Saudia is the flagship carrier in Saudi Arabia that has been operating here for something like 80 years, while Riyadh Air was only recently launched by the Sovereign Wealth Fund and isn't due to start commercial operations until next year. So if the PIF goes in, perhaps takes ownership of Saudia and also operates Riyadh Air, then maybe it can streamline the operations of both of these companies in order to cater to Saudi Arabia's ambitions to become one of the world's most visited destinations.
But Christine, isn't the PIF experiencing something of a cash crunch? How does this play into that?
Yeah, you are right about that, Lizzie. I guess it's hard to answer that until we know the terms of this possible deal. In the past, the Public Investment Fund has received assets from the central government without actually having to pay for them. The idea behind that being that PIF takes ownership of a company from the central government and then gets that company ready for privatization. So perhaps whatever the cash situation is at the PIF is not exactly relevant for this. But to answer your question, yes, the PIF is known to be, or at least our sources are telling us, that the PIF is in need of cash at the moment, as it's spending hundreds of billions of dollars on carrying out the Vision 2030 agenda to diversify the economy away from oil. So we may just see more bond sales from the PIF this year. We may also see them carrying out equity offerings for some of their portfolio companies as they look to really bring in more cash to make sure Vision 2030 gets over the line.
And Saudi banks are also really feeling this squeeze, so much so they might issue a record amount of debt this year.
Yeah, that's right. So Saudi Arabia's banks are facing somewhat of a liquidity situation on their own. And remember, that's also because Saudi banks are also a huge driver of the Vision 2030 agenda. So they are tasked with lending to all these companies out there that are doing things like construction, for example. So also what has driven the liquidity squeeze at Saudi banks over the last couple of years is that they've just been generating so much credit growth in order to meet these spending needs, but deposits have not exactly aligned with that. So things have been a bit tighter, and because of this, they'll probably need to diversify their funding mix. Bloomberg Intelligence says that we may see Saudi banks raise a minimum of $11.5 billion this year in both foreign and domestic currency, as it looks to really fund construction spending needs. Just to give you a bit of perspective here, if we look out just over the next 5 years, the project pipeline for Saudi Arabia is worth more than $640 billion. So, I mean, it's a lot of money these banks need to come up with to lend.
All right, Christine Burke, our Saudi Bureau Chief in Riyadh, we thank you for those insights. And I also want to just talk about oil because, of course, all of this creative fundraising is necessary to offset the lacklustre oil price of late. You had Fitch saying last month that Saudi needs crude to trade above $90 a barrel in order to balance its budget. So higher than Brent's current level, as you can see here, of about $85 a barrel. And we're going to get a raft of market insights on oil from the CERAWeek conference that's taking place in Houston today. Speakers on the docket include the CEO of Aramco as well as the CEOs of Shell and Total. But I want to continue this conversation on Saudi and bring in our next guest, Tarek Fadlallah, Nomura Asset Management's Middle East CEO. Welcome to the studio, Tarek. Great to have you with me. What do you make of Saudi's Vision 2030 agenda, how it's being funded? Are they raising money and executing the plan as efficiently as they possibly could?
Well, Saudi Vision 2030 is a very ambitious program, as you know, and in reality, it could absorb trillions of dollars because of the magnitude of the task at hand. The reality is that the Saudi government has some financial constraints, like all governments do, and so it's having to prioritize certain things. And at the moment, we see the priority on sectors like tourism, aviation, healthcare. Entertainment. These are the low-hanging fruits that the government is committing the available resources to over the short and medium term.
But we were just hearing from Christine about the creative ways of fundraising that they're considering. Why do you think active foreign managers seem reluctant to add Saudi aggressively?
Well, this is the $64,000 million question, because Saudi Arabia has performed very well over the last 12 months. In fact, the TASI is up 27%.
What's it going to take?
Well, that's the point. I think it's partly a communications issue. If you look across the emerging markets, it's difficult to find better transformative stories than Saudi Arabia. It's difficult to find markets that have performed better than Saudi Arabia. And yet the active foreign managers appear to be reluctant. ESG maybe plays into that. Politics, geopolitics maybe plays into that. But the reality is at some point it's going to be detrimental to these fund managers not to be investing in Saudi Arabia.
But how jittery could a fall in the oil price, as we were just discussing, make those investors in Saudi?
Well, I mean, that's a different story. At the moment, Brent is around $85, very comfortable levels for most GCC governments. And so you would think that this should be supportive to stock prices and to foreign investor interest.
And how far do you expect the PIF's bond issuance to go then? Morgan Stanley doubts it's going to stop at $7 billion.
as I said, the magnitude of the funding needs is massive. So I think they will continue to fund as and when they need to, and those numbers could get much bigger.
OK, if we could turn to the UAE, how much of a hit do you expect to the economy from the end of the first fiscal corporate tax year in June?
Well, this is a big unknown. So as you know, we've introduced corporate tax in the UAE. I think a lot of companies have not prepared for that. And so there's going to be a demand on their cash resources at some point in the latter half of this year, and that may impact the economy. So how and the magnitude, all of that is completely new territory for us because corporate tax is new.
Yeah, what about the hit to stocks?
So, I mean, that will be reflected in the EPS numbers. So, of course, the market needs to consider that. So if you're talking about 9% tax rate, don't forget that that's exclusive of some of the deductibles that companies will be able to apply. So in reality, it may affect the bottom line by 3, 4, 5 percentage points.
And then just broadly across the GCC, how much growth are you expecting overall?
So I think in total, the GCC economies will grow around 3% this year. So that's a very comfortable level given where oil prices are.
OK. Great to have you with me in the studio. Tarek Fadlala, Nomura Asset Management's Middle East CEO. Thanks for being here. We've got plenty more still ahead on the programme, so stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, Niger's ruling junta has ended an agreement that let US military staff operate from a $110 million drone base. The move is effective immediately and paves the way for Russian troops to move in. Washington was forced to suspend its operations at Airbase 201 following a July coup and was pushing to keep most of its strategic military assets in the region afloat. We can bring in Ondiro Aganga in Kigali for more details now. Ondiro, bad news for Washington. What prompted this?
A couple of things. The National Protection Homeland Council says that there are a couple of things that they do not appreciate about America. One, they do not appreciate their tone, which they find condescending. And also, they do not like the threat of consequence. And this is because, one, they deem America's presence in Niger as illegal and unconstitutional. And this comes barely a week after a high-level delegation led by the U.S. State Department Assistant Secretary for Home Affairs, Molly Fee, was in Niger to try and ease the tension between the two countries. However, this looks like it was not successful. And this move by the military just goes to show that Niger doesn't care anymore. They're willing to sever any ties, diplomatic or political, with the global West that had been built by the former president, Mohamed Bazoum. And it also goes to show that America's strategy to try and, maintain diplomatic relations with Niger as they convince them to hand over power to a democratic government has failed flat on its face.
And as I say, Ondiro, surely this just paves the way for Russia getting even more of a foothold in Russia. So where does it leave the US in terms of its military strategy on the continent?
They literally need a new strategy because the one that they've been using is almost coming to an end, because once the troops leave Niger, then they have no way of monitoring some of the terror activities that are happening in the region, curtailing the trafficking of drugs and humans. And that is why the base in Niger was very, very significant. What will happen is they might consider moving their base probably to Ivory Coast. There was some conversation when the Secretary Blinken was in Africa. But on top of that, they need a new strategy to also slow down Russian influence on the continent. So far, we know that Russian troops have deployed in Mali, they've deployed in Burkina Faso, and in December, they signed an agreement with the military junta in Niger. So it's only a matter of time before they deploy.
OK, Bloomberg's Ondiro Aganga all across that important story for us. We thank you. We've got plenty more still ahead, so stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, Vladimir Putin has secured another 6 years as Russia's president, winning more than 87% of votes counted so far. The 71-year-old will extend his near quarter century of rule into a fifth term, with his troops on the offensive in Ukraine. For more, we can bring in Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, there's no point asking you who won. There was no surprise here. This victory never was in doubt. Can we call him a dictator now?
Well, what we can say is that a lot of analysts in Western governments did cast doubt on how legitimate these election results were. We know that, for one thing, turnout was astoundingly high. It was higher than it was since any point since 1991, the collapse of the Soviet Union. We know that the Kremlin tightly managed this election. There was no real opposition. There were 3 candidates, but they belonged to loyal parties in the parliament. None of them got more than 5% of the vote. The turnout was very high, some regions claiming over 90%, and Putin took home his record highest support. So clearly they've managed this. They got the outcome they wanted. It was tightly scripted, and in no ways was it free or fair.
Yeah, the British Foreign Secretary David Cameron writing on X, this is not what free and fair elections look like. And you mentioned rivals. One man who might have been a rival was Alexei Navalny, but his widow, of course, speaking after her husband died in that Arctic prison last month. What do we know about the protests that took place around the vote?
Well, Navalny's allies did call for people to show up at noon form long lines to vote, and that did seem to happen. There were long lines in Moscow, St. Petersburg, and some other polling stations. So it appears that people did turn out in defiance of what is the strongest crackdown on dissent that the Kremlin has had since basically the Soviet Union.
And then what does it mean in terms of policy, especially for the war in Ukraine?
Well, we expect to see an emboldened Putin. He actually said in his post-victory speech that he plans to pursue his plans to the very end. This gives him a lot of options. He can tout it as support from the Russian people for his campaign in Ukraine, his war on Ukraine. And he does seem to want to pursue his goals till the very end, and this seems to give him some backing for that.
OK, Bloomberg's Russia economy and government editor Greg Sullivan, thank you for that latest on the Russian elections and their impact on the war in Ukraine. Let's get to some other stories that we're watching on the terminal this morning. We can go to India, where it has been announced that general elections will take place over 6 weeks from April the 19th. The Election Commission says the 7-phase polls will be completed on June 1st, with vote counting on June the 4th. Prime Minister Narendra Modi is bidding for a third term in office, boosted by a strong economy and a weakened opposition alliance that's been struggling to put across a cohesive message. Elsewhere, Donald Trump says he'll hit Chinese cars made in Mexico with a 100% tariff if he's re-elected, double what he previously promised. The presumptive Republican presidential candidate addressed Chinese President Xi Jinping directly at a rally speech in Ohio. Trump has also previously proposed tariffs of as much as 60% on all Chinese goods and 10% on goods made anywhere else in the world. And Boeing's production delays are starting to hit airlines as well, and their passengers, due to a worsening shortage of single-aisle jets. United, Southwest and Ryanair are among carriers scrambling to deal with reduced deliveries as the plane maker focuses on quality control. Carriers say they're trimming schedules and looking for alternatives to 737s that they've already ordered. In other news, IKEA is planning to spend about $327 million in South Korea over the next 3 years to increase the market share there. The Swedish furniture maker will open another so-called blue box store in Seoul and is considering many more smaller formats. IKEA currently has 4 outlets in South Korea. So those are some of our top stories around the world. But the big news this week are the many central banks making decisions this week. I believe it's about 60% of the world's central banks making monetary policy in the coming days. The focus right now on the Bank of Japan. Could it scrap negative rates and hike for the first time in 17 years? This is what markets are fully pricing tomorrow. Epoch-making is how Nomura describes the significance of policy normalisation, both for the Japanese stock market and for the economy. You've got the Federal Reserve as well making its decision on Wednesday. We'll get an updated dot plot. Could we hear a more dovish tone from Jerome Powell in his communications around the meeting. And then on Thursday, we get the Bank of England. Will it deliver an even more dovish vote split itself than last time? Could we see some of the hawks not voting to hike again? We'll keep an eye on all of those central bank decisions for you right here on Bloomberg TV. And currently, we're looking at equity futures stateside pointing to a higher opening. S&P E-minis are higher 0.25%. Nasdaq futures are up 0.4%. You're looking at European futures pointing to a higher opening as well, gaining momentum there after a pretty flat opening, flat read earlier, so higher 0.1% on Euro Stoxx 50 futures. And in the Asia session, the MSCI Asia Pacific Index is higher 0.8% currently, getting a big boost from Japanese equities. The Nikkei 225 is up 2.3%. The Topix in Tokyo up 1.7%. This is because of the weaker yen and very much expectations that the currency is not going to strengthen if the Bank of Japan hikes. You've got your Treasury yields there on the screen, very much steady across the curve, but a real climb from last month as traders have paired their Fed rate cut bets. So all eyes on Jay Powell at the Fed meeting this week. The dollar is pretty steady at this point, and it had its best week since January, you might note, last week. We'll have plenty more on all of that in our next hour of Bloomberg Middle East and Africa. We're going to be discussing the potential market reaction to all of those central bank decisions, and we'll bring you more on the latest in this region. So stay with us for more exciting conversations. This is Bloomberg Daybreak Middle East and Africa. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks climb led by Japanese shares, with the BOJ now widely expected to end its negative interest rate policy tomorrow. China's factory output and investment grow more than expected, showing stimulus measures are helping. However, consumers are still not stepping up. Plus, Israel's military targets Al-Shifa hospital in Gaza, citing Hamas activity as Prime Minister Benjamin Netanyahu vows to continue the war. It's just gone 9 a.m. across the Emirates. I'm Lizzie Burden in Dubai. Good morning. Welcome to a new week, and it is set to be a big one for central banks. You may see the Bank of Japan hiking tomorrow for the first time in 17 years. Markets are fully pricing that now. Epoch-making is how Nomura has described policy normalisation, not just for the Japanese economy, but also for the stock market. And you're seeing the effect of that already in equities this morning. If you take a look at the MSCI Asia Pacific Index, it's getting a boost, higher 0.8% because of Japanese equities, because of the weaker yen. The expectation that the currency is not going to strengthen even if the BOJ hikes. You've got European futures higher as well, higher 0.1% on Euro Stoxx 50 futures as we await that Eurozone CPI number at 2 p.m. Dubai time, and US futures also pointing to a higher opening now, gaining momentum after a really dismal end to the week on Wall Street. If we flip over to the cross-asset picture as well, you've got the two-year Treasury yield holding steady at 4.72%. But do note this is a real climb from last month because traders have pared back their Fed rate cut bets. The dollar also steady after its best week since January, and Brent steady too at $85 a barrel after its biggest weekly advance in a month. This, of course, as Ukrainian attacks on Russian refineries have really stoked geopolitical risks. Finally, iron ore trading at $100 a tonne. It has been at its lowest level since last May, and we can cross over now to Avril Hong. She's in Singapore. She's been watching the data, perhaps behind that iron ore reading. Avril, what's been happening where you are?
Yeah, we got data out of China that activity indicator for the first 2 months, it was a mixed bag. We had retail sales showing a slight disappointment, but I think what investors really focus on is the pickup in industrial production as well as investment. And it seems like we're in a stage for the markets where the positive surprises matter more, or perhaps impact the market more than the negative ones. That seems to be the read-through, at least across assets today. The CSI 300 higher by about 0.5%. That being said, the Hong Kong benchmark not giving us that much direction. Still some flows into the bond space, and the offshore yuan is still hovering at that 720 level. Let's flip the board because I want to take you to the Japan bond markets as well. We're seeing ahead of tomorrow, it seems like futures as well as the 10-year have reversed some of the moves from last week, despite that speculation mounting that we're going to see it imminently on the BOJ, that tweak to policy. We have the BOJ today coming through with a massive liquidity repo operation. The signal to the market seems to be that it wants to cap any fluctuation in the bond space. It will not tolerate that. And amid all this, we also get the sense that for the yield and 10-year to move to 1%, let alone 2%, is going to take a really long time. So this is what we're seeing in Japan.
All right, Avril Hong in Singapore, we thank you. Interesting that we're increasingly hearing this slogan from China, new productive forces. Perhaps a reflection of that in those industrial production figures. But it is a big week for central banks. Let's get back to our theme of the week. We've got the Fed and the Bank of Japan among those set to make rate decisions that really are going to affect half of the world's economy. You've got economists seeing Fed officials holding steady, the BOJ as well, now widely expected to finally end its negative rate policy tomorrow. So we can bring in for more our MLive strategist, Mark Cranfield. Mark, what sort of market reaction are you expecting if the BOJ does indeed ditch negative rates?
Well, the traders have had plenty of time to price in a move from the Bank of Japan. As we've been discussing for the past week, practically every day there have been media reports warning us that the Bank of Japan is getting close, that all it needs is a wage increase, which we got from the Renko unions on Friday. That will be the last piece in the puzzle. So, and we've also had a Nikkei leak over the weekend as well, saying that it's pretty much a done deal. Tomorrow, Bank of Japan is going to go out of negative rates and they're going to start a new era where we actually have positive numbers in Japan. Now, given that they've had all that time to price that in, and they're also doing it against the backdrop of the Federal Reserve to come in a few days' time. So here we are, dollar yen's around about 149. And if people are really thinking that the Bank of Japan is going to make a huge impact, you would expect the yen to be much stronger than it is at that level. So really what it's telling us is that traders now expect only the Fed is really going to make a huge difference, particularly to the currency market. So really, when it comes out tomorrow, no doubt there'll be a lot of fluctuations. There'll be some whiplash, but we'll probably end up with dollar yen not too far away from wherever it starts the day. But the big impact, if there's going to be a chance for the yen to get stronger, dollar to go lower, it really will come from the Federal Reserve later in the week. And the surprise now would be that the Federal Reserve leaves the dot plots at 3 cuts for this year and doesn't change it to 2. Because if you look at the price action in treasuries, 10-year treasuries had their worst week last week of the whole year. That suggests that the traders in the bond market do expect the Fed to be more hawkish this week than they were at the previous meeting. If they surprise people and maintain 3 rate cuts for this year, dollar yen can probably go lower. If that doesn't happen, we're probably looking at dollar yen eventually drifting up, probably back towards the highs that we saw earlier this year.
Perhaps I should have asked you how the market would react if the BOJ didn't hike tomorrow. Of course, the BOJ not always known for the clearest communications. But you mentioned the Fed, you've got the dot plot. What about the communications from Fed Chair Jay Powell? Could he actually sound a bit more dovish, given his own history of being very sensitive to signs of slowing activity, despite the hotter-than-expected inflation readings?
He has certainly been one of the most dovish members of the Federal Reserve in recent months. And if we do get a situation where the dot plots are changed to only 2, he most certainly will use the press conference after the meeting to try and calm everybody down and say, hey, don't worry, we're not about to start raising interest rates or anything like that. We're still on a path towards lower rates. So certainly he's the one who's more likely to try and play down expectations if there is a change in the dot plots. Even if the dot plots are left unchanged, Jerome Powell is certainly one of those who has said previously He expects interest rate cuts to begin about the middle of the year, and he'll probably keep with that policy as well. But if you notice that there's a lot of Fed speakers who are going the other way, they're actually sounding as though they're willing to push back a lot further than he is. And we've got this new report from our own economists in New York saying that if they calculate all the headlines from Fed speakers, it now looks as though July would probably be the earliest. When you assimilate all those numbers, July is probably the earliest that the Fed would go.
OK, Bloomberg's Mark Cranfield with an eye on all of those central bank decisions taking place over the coming week. We thank you. But continuing with the Bank of Japan, we asked our guests on their views regarding the Nikkei and whether the rate hike will mark an end to the bull market in Japanese stocks. Take a listen.
We've been saying that the Bank of Japan is very likely to be tightening policies.
My view is that it will be a very dovish exit.
Market split between a March and April exit from negative rates.
Japan raises interest rate, the US goes lower, the yen strengthens a little bit.
I don't think that they want to risk any financial instability.
The stock market has performed very well on the weaker yen, amongst others. So that could take a bit of the zest out of that.
Yes, there will be hiccups, and it seems that these couple of months would be a little bit rough for Japanese equities, but at the same time, they can give you opportunities.
The money then leaves Japan. Where does it go? That's the interesting one. And that could bring us back maybe to China.
Well, joining us now to continue this conversation is Anita Krishna-Gupta, Emirates NBD's Head of Equity Strategy. Anita, great to have you in the studio. When the Bank of Japan does hike, is it going to trigger a flood of Japanese selling of overseas assets in order to bring that money home?
Yeah, morning, Lizzie. So what we are expecting is that whether the Bank of Japan were to take negative interest rates back to zero or a little higher tomorrow, it's going to happen sometime this year. Okay. So whether it's tomorrow or later, I don't think that really is so, crucial for Japanese markets. Now, what we do expect in terms of, Japanese markets is the fundamentals are going to continue. So the hike that we have seen, the rise in the Nikkei, the TOPEX has been more fundamentally driven by the Tokyo Stock Exchange, which brought in some capital market reforms. And we've seen the yen kind of stay at 149. We've seen the yen maintain that little bit of weakness. So we don't think that, you're going to see that yen move too much. Market should stay steady with a little bit of volatility, of course, which is normal in markets. I don't think that this BOJ decision tomorrow is going to impact markets greatly.
So you're confident in the fundamental strength of Japanese equities?
Yes, we are. We are overweight Japanese equities, and I don't think that just one BOJ decision is going to make or break the market.
But how hard do you reckon the start of BOJ tightening will hit the banks in Japan?
So very definitely now what we do expect, as you rightly said a couple of minutes ago, is yes, you will see some money inflow coming back into Japan. Also, the other decision around the BOJ is, are they going to, is there going to be a stop in buying ETFs? Because so far the market has been supported by government, by pension fund buying of ETFs. So that is one little impact on the markets that we do expect. And again, as I said, fundamentally positioned on Japan, see the upside continuing into the end of the year based on the fact that, companies are increasing shareholder value, returning money to shareholders, and exporters would be affected if there was a bit of a stronger yen. But let's see how that pans out.
OK, so optimism on Japan. Let's turn to the Fed, because we had this raft of eco data out of the US last week. Do you think that Larry Summers is any more right after all that to have said there is a meaningful chance the Fed's next move is a hike? Traders have really pared their bets on a cut.
Our own house view is, at this point, is that the first cut is in June, and we're going to probably have 3 cuts into the year end. Now, I think we have to wait to see what Chair Powell says this week. And, of course, we know about expectations that even if 2 of the officials were to change their views, then expectations on cuts would go down from 3 to 2. But whether that's going to translate into any kind of, hawkishness around a hike later, I don't think, not at this meeting for sure. That's yet to be seen. Inflation numbers stay sticky. And also, I think what's very positive about the current inflation, it's more growth-linked. Any hikes, that we have seen from the Fed in the past and holding the rate steady is based on the fact that the economy is strong. So that's, again, positive for US equity markets.
Of course, equity markets very enthusiastic for the cuts to come. But I wonder if a bubble is forming in US stocks, how much room does it have to grow before it bursts?
Our view at this point is that the S&P 500 is, going to be kind of range-bound between 5,000 to 5,200. That's where we have seen it. Concentration in the market remains. You've got the top 10 stocks, which are about 33% of the S&P 500, but they're also contributing to 25% of the earnings growth. And we continue to see that the big tech companies and anything which is AI-related in the S&P 500 Q4 calls, about 179 companies spoke about AI. So we still have that AI-driven productivity growth, and it's just the start of that. So the bubble, I wouldn't call it a bubble, but we do expect volatility. I do expect that you will see at least a couple of 5 to 10% corrections.
So you're not worried about that concentration risk?
The concentration risk is in a way justified, and it's not new. I think the market's been functioning on that concentration for the last 5 years. So it's not a new phenomena. It's just got more highlighted with NVIDIA's exponential rise in share price.
And just very quickly, where are you putting your money when it comes to EM equities?
We are overweight India. We are neutral China. And I think we're going to stay with that. So we look to India for growth. We look to the UAE for dividend yield. So those are our two overweights at this point. India, we think, is a secular growth story.
Brilliant. Very comprehensive for us. Anita Krishnagupta, Emirates NBD's Head of Equity Strategy. Lovely to have you on the programme. Thank you. Still ahead, we're keeping an eye on oil moves as economic activity in China beats expectations and Ukrainian attacks on Russian refineries heighten geopolitical risks. We'll have more on commodity markets later in the hour. But up next, Benjamin Netanyahu rejects calls for fresh elections and says Israeli troops will enter the southern Gaza city of Rafah within weeks. We'll bring you the latest on the war next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, Israel's military has made its deepest incursion into Gaza City in about 2 weeks. It's been targeting Al-Shifa Hospital and cites Hamas activity. It comes as Prime Minister Benjamin Netanyahu has vowed to continue the war. He also pushed back against comments by the US Senate Majority Leader Chuck Schumer, who last week called for fresh elections in Israel.
What he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic.
Well, let's get more now from Bloomberg's Stuart Livingston-Wallace. Stuart, I watched this interview live. Netanyahu effectively arguing that Israelis support the war, so Schumer calling for fresh elections in Israel is just not appropriate. How close to breaking point are US and Israeli relations?
I mean, it does look tenuous. I would say it's the worst it's been for a good long time, certainly in living memory. And when you think of how dependent Israel is in terms of US aid, both financial but also militarily, that's not a good sign. And there seems to be a fundamental impasse here between what the Biden administration needs in an election year and what Bibi has promised his electorate in terms of his objectives in this particular war against Hamas. And the two seem irreconcilable. Now, quite what Biden can do about it is really hard to tell. So the pressure is on both sides to try and find some sort of compromise here, but it's hard to see where that middle ground is.
Yeah, and then we're looking at the assault on Rafah to come, Israel's war cabinet approving that on Friday, despite the pressure to end the war internationally. How is it going to play out logistically? What sort of time frame are we talking about?
I think probably weeks. Now, no one inside Israel, that is within the sort of the authority in Israel, is giving us a hard steer on this is exactly what the time frame looks like, this is when things are going to unfold. But the sort of the general idea we're getting is that it's going to be probably several days, maybe even several weeks to try and move those civilians out of that area. Quite where you move them to, no one has much of an idea, and I'm not sure there really is a plan as such at the moment. And then beyond that, I think everyone is very vague on how long it's going to take to do the Rafah offensive. Partly because they don't quite know what things look like on the ground. You know, and as they've experienced throughout northern Gaza, things are often very different on the ground once you get there. And again, the Israeli army, the IDF, is being quite cautious about how it's doing these offensives.
Yeah, and you have to wonder whether people will stay and whether Hamas is just going to embed itself in wherever they end up going.
Yeah, and again, that has been the track record so far. So on the one side, you've got the IDF trying very hard to preserve soldiers' lives, you know, and in terms of the casualty rates we've seen on that, they have been, relatively speaking, quite low, given the scale of the offensive. And then, yes, as you say, on the Hamas side, they're sort of embedding themselves throughout the civilian population, and as such, making it incredibly difficult to sort of fight it in the normal sense.
OK, Bloomberg's Stuart Livingston-Wallace, we thank you for that update. We'll have plenty more still ahead for you, so stay tuned. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, Sheikh Ali Rashid Al Saeed Al Maktoum is setting up a family office in Hong Kong with as much as $500 million. The member of Dubai's ruling family spoke exclusively to Bloomberg alongside the CEO of the new family office about the venture.
Why not Hong Kong? I mean, you know, for me, I would say that during my first visit, which was early, actually December last year, I got to see a lot of similarities with Dubai. I think Hong Kong is very advanced in so many aspects. It has so much to offer in terms of investments, opportunities, and business expansion. And I can see like there's a potential for long-term growth that can happen. And so we kind of went on with the idea, and through a few friends, through talks.
Okay, Eleanor, let me bring you in. What are your initial plans? What's the initial priority here?
Yes, in Hong Kong, because we are looking for the projects that interest in our sectors like AI, construction, EV, and also tourism and fintech. Yes, that we can interest and invest in, and then also we help them to scale up in Dubai and UAE.
Okay,
yeah.
And how big's the fund?
It's up to $500 million.
Okay. And ticket sizes of the investments, how much are you looking to do per transaction? I know that's a moving target, but is there a range that we can
We are open to the, yes, it depends on the scale. Is it startups or projects or construction, yeah.
Do you guys have any targets in mind in terms of specific investment targets at the moment yet?
I think nothing at the moment, but I think it's in the work, in the process. We're open to exploring so many options, and you know, so I think there's you know, through collaboration stuff, I think things will start shaping up and be more clear in time.
Right. When are you looking to make your first investment, if not already?
The first investment would be the construction one, because it's got a very good policy in UAE. Yes. Yeah.
Do you have a timeline for that? When the first?
It would be within this year. Yeah.
Maybe next quarter.
Yes,
or
maybe
towards
next
the end of the
quarter,
year. Yeah.
Okay. And you guys are in talks already with potential target companies,
yes.
I would imagine?
Yes, we are. Yes, we are.
Okay,
Yeah.
Talk to us about parallels between, you know, Hong Kong is the first family office outside of Dubai, of course. Yeah, what are the parallels that you're looking to take advantage of, Hong Kong and Dubai, for example?
I think, first of all, Hong Kong, you know, it has the services in terms of, you know, the legal and investment management. I think this is which is very appealing, actually, and also the connection to the Greater Bay Area in the mainland China, which is what we, even back in Dubai, we hugely look up to, and we were very much aspire also by the technologies and also the investment movement that has been shaped over the past maybe 50 or even 100 years. And it's known that China and Hong Kong are one of the leading players in terms of investments and opportunities. So I want to take advantage of that.
So that was Sheikh Ali Rashid Ali Saeed Al Maktoum from the ruling family in Dubai and Eleanor Mack, CEO of the new family office in Hong Kong. Now, we do have some breaking news for you that Apple is in talks to let Google Gemini power its iPhone features, AI features on iPhones. It really sets the stage for a blockbuster agreement that would shake up the AI industry. The plan is potentially to let Apple license Gemini, Google's set of generative AI models, of course, to power some new features that are coming to the iPhone software this year. It would build on the partnership between Apple and Google, and it would give Gemini a key edge with billions of potential users. There'll be plenty more ahead. This is Bloomberg. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks climb, led by Japanese shares, with the BOJ now widely expected to end its negative interest rate policy tomorrow. China's factory output and investment grow more than expected, showing stimulus measures are helping. However, consumers are still not stepping up. Plus, Israel's military targets Al-Shifa hospital in Gaza, citing Hamas activity as Benjamin Netanyahu vows to continue the war. It's just gone 9:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai. Welcome to a new week, and it is set to be a big week for central banks around the world. You've got the Bank of Japan making its decision tomorrow. Markets now fully pricing in a hike from the BOJ, the first time in 17 years. Epoch-making is how Nomura describes policy normalisation both for markets and for the Japanese economy. You are seeing the reflection of that in markets this morning. The MSCI Asia Pacific Index higher 0.9% as you're seeing this strength in Japanese equities because of the weaker yen and the expectation that the currency is not going to strengthen even if the BOJ hikes. You've got European futures pointing to the upside, 0.2% higher as we await the Eurozone CPI print at 2 p.m. Dubai time, and US futures also pointing to a higher opening after not such a great end on Wall Street last week. If we flip over as well to the cross-asset picture, you've got Treasury yields steady, the 2-year at 4.71% now, but a real climb from last month as traders have pared back their bets on Fed cuts. The dollar steady too, as it had its best week since January last week. Brent trades at $85 a barrel after its biggest weekly advance in a month. This as Ukrainian attacks on Russian refineries have stoked geopolitical risks, and iron ore has been at its lowest level since last May, now trading at $101 a tonne. Let's get over to Avril Hong now in Singapore. She's been minding perhaps the reasons for those iron ore moves. Avril, you've been watching the China data.
China data and China demand, I think that speaks to what we're seeing on iron ore prices. I'll get to that in a bit. But let's recap what we saw for the first 2 months on the Chinese economy. Those activity indicators showed us a miss slightly on retail sales. Property is still a big concern. But I think what investors are really focused on are those pickups in industrial production as well as investment. At this point, it looks like for the markets, the impact matters more when we see positive surprises rather than negative ones. There are some economists who say that the improvement in the data might mean there's less of a need for imminent stimulus, but we're still seeing the CSI 300 in the green today, 0.6% higher. Let's flip the board and take you to the commodity. Iron ore contracts finished last week below $100 a ton, and it was double-digit declines for the week. But as you mentioned earlier, we're seeing that improvement slightly on the contract today. And this is despite the data showing us how steel production barely moved higher. As I say, it is the focus on the positives for the assets in China as well as the commodity. Lizzie.
OK, Avril Hong in Singapore, we thank you for that update on Asia markets. And now let's bring it back to the Middle East, because Saudi Arabia's sovereign wealth fund is said to be in talks to acquire the kingdom's flagship airline, Saudia. Sources say the deal could result in the company being taken private or merged. And for more details, we've got our Saudi Bureau Chief, Christine Burke, in Riyadh. Christine, what do we know about this potential deal?
Well, good morning, Lizzie, from a rainy and gloomy Riyadh here today. So what do we know about this deal? Well, the first thing that I want to say is that these discussions around the Public Investment Fund possibly taking ownership of Saudia are thought to still be at an early stage. So our sources are telling us that this deal, if a deal does indeed go ahead, probably won't happen until 2025. But the idea is that the PIF will take ownership of Saudia from the central government with the aim of turning Saudia into a company that is more efficient and more profitable. If the PIF is able to do that, then it may pave the way for a possible privatization of Saudia, or perhaps even a potential merger with Riyadh Air. To give you a bit of history about these two different airlines, Saudia has been operating here in Saudi for about 80 years. Riyadh Air is an airline that was only recently launched by the Sovereign Wealth Fund and isn't expected to start commercial operations until next year. So if these two airlines do end up coming under the ownership of the PIF, and the PIF maybe can streamline their operations, then it sounds like these two airlines will be able to better cater to Saudi Arabia's vision to become a global tourism hub. I think the idea is that Saudia will really carry more of the passengers that are going on religious pilgrimages, while Riyadh Air will become the go-to airline for international tourists.
But Christine, guest after guest on this programme talks about the liquidity issues in Saudi Arabia. Isn't the PIF experiencing something of a cash crunch, and how does this play into that?
Yeah, so our sources have been telling us that the PIF is seeing a greater need for cash as it really ramps up spending to support the Vision 2030 initiative to diversify the economy away from oil. But when it comes to this Saudia deal, the one thing that I will say is that in the past, the PIF has traditionally received assets from the central government without needing to pay for it. The idea here being that the central government transfers ownership of a company to the Public Investment Fund, and then the Public Investment Fund works to improve that company so that it gets ready for privatization. So I can't say that that's what we're seeing here, but if we do see a structure similar to that, then perhaps the PIF's cash level isn't exactly relevant for this particular story.
And you've got Saudi banks, as I say, feeling the squeeze. How much might they issue in terms of debt this year? It looks like potentially a record amount.
Yeah, that's right. So Saudi banks are also very much like the PIF, experiencing somewhat of a liquidity squeeze. Saudi banks are also big drivers of lending to the economy to support also everything that's going on with Vision 2030. They have been expanding credit at a rapid clip over the last couple of years, and the deposits that back that credit growth just haven't really been aligned. And so that is what has been creating this liquidity squeeze that we are talking about. Bloomberg Intelligence says that due to this and due to the sheer size of the spending needs on construction alone, we could see Saudi banks issue something like $11.5 billion of debt, both foreign and local, in the year ahead. And just looking ahead to the pipeline for construction, Saudi Arabia has some $640 billion worth of projects that are coming up in just the next 5 years. So there are big spending needs, and banks will be expected to diversify their funding mix in order to meet the requirements for expanding credit and lending to companies out there that need it.
OK, Saudi Bureau Chief Christine Burke in Riyadh, a gloomy, miserable-looking Riyadh. We thank you for that update on the PIF bond binge. And now back to that Bloomberg scoop that we were just discussing. We've learned that Apple is in talks to build Google's Gemini artificial intelligence engine into the iPhone. It's a move that really could shake up the AI industry. And for more, we have the man behind that scoop, Mark Gurman. Bravo, Mark. What are the details about this partnership?
Yes, thank you so much, as always, for having me. So some late breaking news. Apple and Google are in talks for Apple to license Google Gemini. That is Google's latest artificial intelligence generative AI model for use on the iPhone beginning later this year. Apple has been working on several new AI tools and services for iOS 18, this next iPhone software update. Those are going to be based on Apple's homegrown AI models that Apple needs a partner for generative AI. That is the AI that all of us have been talking about for months, similar to ChatGPT, obviously Google Gemini, Anthropic, they have Claude, Perplexity. And they're looking at partners for that. And they've talked to two central potential partners here, Google and OpenAI. The OpenAI talks were recent, but it appears all eyes are on this Apple and Google partnership, with Apple and Google in active negotiations for Apple to license Google Gemini. And like you said, this would be a blockbuster agreement that has the potential to transform this still growing AI industry.
Okay, so hugely significant. What's it going to be like for users? What would it entail?
So right now, the discussions between Apple and Google, I would say they are midstream. They're not early and they're not late stage. They are active. They have not finalized commercial terms, how Google branding would be featured. They have not finalized the implementation or how this exactly would be integrated into the system. Theoretically, it would be integrated into Siri, no different than search engine from Google being implemented into Safari. This is very significant. There are signs that the major Apple and Google search engine partnership could be paring back, at least in some regions. Obviously, the Department of Justice in the US is suing Google over their search engine partnership. Apple generates a lot of revenue, maybe $8 to $12 billion per year from Google on that search engine partnership. Google obviously generates a lot of money as well, tens and tens of billions from the partnership. So shifting from search to AI gives both of those parties some backup revenue in case things fall apart on search.
Okay, so billions of potential users, a very exciting deal. But doesn't it reflect actually that Apple wasn't as far along with its AI efforts as some might have hoped?
It reflects the fact that Apple's AI efforts related specifically to generative AI, they don't believe are up to snuff enough to implement a Gemini-like chatbot, a ChatGPT-like chatbot. And the best way to do that is to license what is the best. They'll likely make the same argument for going with Google Gemini as they did for why they're going with Google Search versus using a more nascent provider or building a search engine on their own. No need to build a chatbot with your own generative AI models and building your own cloud infrastructure, at least from the get-go, if you can rely on what's considered the best to do so and potentially make some money from that company and have them pay you on top of it.
Okay, Bloomberg's Mark Gurman with a fantastic scoop. We thank you for bringing that to us, Mark. Now, let's turn to airline, because Boeing's production delays are starting to hit airlines and their passengers now due to a worsening shortage of single-aisle jets. United, Southwest and Ryanair are among the carriers scrambling to deal with the reduced deliveries as the plane maker focuses on quality control. For more, let's bring in Bloomberg's Asia Transport team leader, Katrina Nicholas. Thanks for being with us, Katrina. What does this mean for the busy summer travel season ahead?
Well, look, as you said, it's really the US carriers that this is impacting a lot. So the likes of United, Southwest and also Ryanair, they're scrambling to respond to this reduced deliveries. And what that means, it's particularly for the 737 and also to an extent Airbus's A320 family of jets. Now, they're the sort of jets that fly mid-range to short distances. So you're looking at sort of 5 to 6 hours duration rather than those big, long international flights. So largely it's domestic flights that are going to be impacted. So, you know, fewer flights, fuller aircraft, and that's probably going to mean higher fares ultimately. We're hearing from Amex GPT that for LA to New York, business fares could rise as much as 8.5%, while for Seattle to San Francisco, for example, we could see fares up as much as 18% across the two cabins. So, you know, that's particularly painful for the flying public, particularly amid rising inflation in many parts of the world.
And is it as simple, Katrina, as Boeing's loss is Airbus's gain?
Well, you know, to an extent, yes. I mean, Boeing does seem very uncertain as to when its planes are going to be ready and it's going to get its delivery schedule back on track. You know, they've got their army of US inspectors going all throughout their factories at the moment in light of that new disaster we had in January with Alaska Air. So really, the company can't make any firm predictions at the moment when things might return to normal. We're looking for an update later this week when Chief Financial Officer of Boeing, Brian airline West is expected to share an update on how the plane maker's work is going to boost these quality controls. But, unfortunately, there just doesn't seem to be any relief in the short term. We had Steve Townsend, who runs a big aircraft lessor, BOC Aviation. He said last week that it's going to take, several years for this really to catch up and get back on track again. Pandemic-related production delays across both Boeing and Airbus have set airlines back about 4,000 new planes over the last 3 to 4 years. So, I can see that imbalance perhaps taking, several decades even really to shake out.
Eesh, and you can see on the screen there, shares down in Boeing nearly 30% year to date. But I also want to talk about another story, the news earlier that Korean Air may be closing in on a large Airbus order. Can you tell us a bit more about that?
Yes, and this is one going, it looks to be in Airbus's favour. So we heard that this morning that Korean Air is pretty close to a significantly large Airbus A350 order, maybe as many as around 20 jets. This fleet decision comes ahead of its merger with Asiana Air, which is now just awaiting US regulatory approval. This enlarged Korean Air, basically what they're trying to do is reduce the number of jets they fly across this more broader merged airline. And across those Boeing and Airbus family, basically streamlining them. Now, Korean Air, they don't currently fly any of those Airbus A350s, but Asiana Air does. They've got about 15 in its fleet, and they've got about 15 more on order. And we're hearing that a firm decision on this might come as early as Thursday after a board meeting that Korean Air is having.
OK, Bloomberg's Katrina Nicholas in Singapore. Thank you for that update on the dismal times for Boeing. We've got plenty more still ahead for you. Niger comes next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. To some bad news for Washington now. Niger's ruling junta has ended an agreement that let US military staff operate from a $110 million drone base, and that move is effective immediately. It paves the way for Russian troops now to move in. Washington was forced to suspend operations at Airbase 201 following a July coup and was pushing to keep its most strategic military asset in the region afloat. But we can get more details now from Bloomberg's Ondiro Oganga. Ondiro, what do we know about this and what's prompted it?
Lizzie, two things broke the back. One, America's tone has been found to be condescending, and two, Niger does not appreciate the threat of consequence. And that's why we saw the National Council for Homeland Protection say that America's presence in Niger is not only illegal, but against the Constitution. We're talking about a drone base worth of $110 million and over 1,000 boots on the ground. Such a blow to America, because barely a week there was a high-level delegation in Niger trying to diffuse the situation. And we can read two things from this move. One, Niger doesn't care anymore to sever whatever is left of their diplomatic ties with the global north, but also America's strategy to maintain cordial ties with Niger as they try to convince them to revert back to democracy has fallen flat on its face, which will in turn affect America's efforts to counter Russian influence on the continent.
Indeed. So what does it mean for US military strategy going forward on the continent?
They need new partners. They need to establish new security partners, particularly with coastal West African countries. When Secretary Blinken was on the continent earlier on in the year, he pledged $45 million in terms of support, plus military equipment and intelligence support, bringing total support to $300 million. They'll also need to move their drone base to an alternative country. It was very critical because it played a huge role in collecting critical intelligence that helped in counterterrorism operations and also helped counter the smuggling of drugs and people. Most importantly, a new strategy to counter Russia's growing influence on the continent. They're already in Mali. They've deployed in Burkina Faso. And in December, they signed a deal with Niger to mean it's only a matter of time before they deploy in Niger too.
But, of course, also over the vast Sahel region, you've got the jihadi groups linked to al-Qaeda and the Islamic State group operating. We thank you for that really great reporting. Ondiro Oganga, live in Kigali. We've got plenty more still ahead on the programme, so stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, India has announced that general elections will take place over 6 weeks from April the 19th. The Election Commission says the 7-phase polls will be completed on June the 1st, with vote counting on June the 4th. Prime Minister Narendra Modi is bidding for a third term in office, boosted by a strong economy and a weakened opposition alliance that's been struggling to put across a cohesive message. And we can stay with elections now. Vladimir Putin has warned that Russia will not be stopped from pursuing its goals. His defiant words come after securing another 6 years as president, with a record victory in a tightly controlled election where he faced no serious competition. Let's bring in Greg Sullivan, Bloomberg's Russia economy and government editor, for analysis now. Greg, there's no point asking you who won. It was always going to be a one-horse race. Can we call Putin a dictator now?
Well, you're certainly right that this was a foregone conclusion, a rubber-stamped election in which the Kremlin tightly managed both the election process and the outcome. There was no real opposition. There were 3 candidates that were on the ballot besides for Putin. None of them got over 5%, and they were all representing parties that were loyal to the Kremlin. So the Kremlin really did get the outcome that they wanted, but they made sure that that was what was going to happen.
OK, so not a free or fair election. That's what the British Foreign Secretary David Cameron wrote on X. Meanwhile, you had a lot of attention on who might have been the rival, Alexei Navalny, and his widow, present at the amongst the crowds of voters going to the polls. He, of course, died in an Arctic prison last month. And what was striking was that Putin referred to him. That's new, isn't it?
It is. It was actually quite shocking to hear. In his post-election speech, he actually did speak about Navalny, and he said that he actually confirmed that there was a swap that he had agreed to for unnamed people in Western jails, and he actually spoke Navalny's name for the first time in years. Of course, Navalny's allies had called on people to actually protest the vote by showing up at polling stations, and they did appear to do that as there were long lines at noon, the specified time, in places like Moscow and St. Petersburg.
I mean, what do you read into that? Is it kind of saying, you know, look, I've won now, I'm going to speak his name now? What are we meant to take from it?
Well, I think you said it best when you said that Putin gave a very defiant speech. He was very emboldened, and that came across in his speech. He vowed to pursue his ends for years to come, and I think in some ways this election does set him up to pursue what he plans in a more emboldened fashion. So defiance is definitely the word that I would use.
OK. Well, Greg Sullivan, on that Russian election, we knew who was going to win, but of course it cements Putin's rule in Russia. Well, thank you, Greg. We are looking ahead to Daybreak Europe coming up next. Tom McKenzie will join you for that, as you have futures pointing to a higher opening on Wall Street and in Europe. S&P E-minis up 0.3%, Nasdaq futures up 0.5%, and Euro Stoxx 50 futures up 0.2%, as we await that crucial Eurozone CPI figure coming at 2 p.m. UAE time. You've got Treasury yields pretty steady on what is set to be a crucial week for central banks. You've got the BOJ, the Fed and the Bank of England all very much in focus. Tom McKenzie will take you through analysis of all of that, so stay tuned. That's it for Bloomberg Middle East and Africa. This is Bloomberg.